All right, let's talk about held to maturity investments.
What?
And why I think GAAP, FASB needs to change the rules related to held to maturity investments, because this accounting practice is outdated. So what are held to maturity investments? Why are they different from other accounting methods for investments? Held to maturity are mainly going to be bonds, CDs, anything that's a fixed income type of investment. You're never going to see equities in held to maturity. The big difference is you do not mark them to fair market value. So why are they held at cost? Well, the assumption is you have the intent and you have the ability to hold this fixed income, this debt instrument, until it matures. So why mark it to fair market value if you're just going to hold it and get the full principal back? You're earning your interest, you're getting the full principal back. Why mark it to fair market value? Well, let's dive into that, because I'm saying these held to maturity, stick them into available for sale. Let's get rid of held to maturity, so you're marking these to fair market value along the way, so you have a much better sense of what the business health looks like. So let's give an extreme example with Silicon Valley Bank. Silicon Valley Bank's 12/31/22 annual report has 91 billion of held to maturity investments on their balance sheet, and yielding on a weighted average basis 1.66%. Now, back in 2021, 2022, interest rates were extremely low during the COVID, coming out of COVID. But now, with inflation going up in 2022 and 2023, the Federal Reserve has been very aggressive in raising interest rates. And a treasury right now is yielding anywhere between 4 and 5%. So if you have a weighted average 1.66% on your investments, and you can go to the market and get a 4 or 5% treasury bill, those bonds, those notes that you're holding on your balance sheet are worth substantially less. So the equalizer when you sell a fixed income or a bond investment is you lower the face value. And lowering the face value is recognizing a loss on that investment. And that's going to be a drastic loss. It would have been a drastic loss in this situation if you have a 4% treasury versus a weighted average portfolio of 1.66%. Held to maturity investments should not be held to maturity. They should just get lumped into available for sale and marked to fair market value, so investors, anyone else that's banking with them, knows what is happening with Silicon Valley Bank's portfolio or their investment portfolio. I think we need to abandon held to maturity investment accounting and go strictly to available for sale and trading. Just keep those two. So you're marking your investments to fair market value. You're reflecting the actual fair market value on the balance sheet. And even if you can't get the unrealized gains and losses on the income statement, you can at least see them in other comprehensive income. Let me know in the comments if you don't agree. If you do, let me know why you agree. And I hope you learned something, and I will see you in the next video. Take care. Goodbye.